one of the things we all should be thinking about, whether we're 30 years old, we're 50 years old, or 70 years old, is when I'm in retirement, what is the tax characteristic going to be of the money that I'll be withdrawing from my retirement accounts? The longer you have to think about this and to make changes, the easier it is to make sure that you have money in accounts that are going to be taxed in the most tax efficient way for you. One of the things you want to try to avoid is being forced to take taxable income. And where that comes into play is with traditional IRAs and traditional 401ks because of their required minimum distributions. That can get very sizable very quickly. So you want to be careful there, and the tax nature of the withdrawals that you take from retirement matters, and it matters a lot. It's going to impact the taxability and the cost for many things. Let me just give you a handful of examples. It's going to impact the taxability of your Social Security. It's going to impact what type of subsidy that you might qualify if you need health care before you're 65 through the Affordable Care Act. It's going to impact the tax rates and even taxability, because there's a 0% tax rate on dividends and capital gains until, frankly, you're making a fair amount of money. And it's also going to impact the cost of your premiums for Medicare Part B and Medicare Part D. D is for your prescription drugs, and Part B is for your outpatient doctor visits, things like that. So it has a huge impact, but unfortunately, most people don't think about it until they retire, and then they're like, oh my goodness, what have I done? I really wish somebody had told me this. So somebody's telling you this now, and I want you to be thinking about it now, because I don't want you to be in this situation. It's very important, and I encourage you to think about it early in your retirement. Early, like I said, 30s is not too early to be worried about this. Again, you want to avoid being a recipient of forced taxable income. If possible, you want non-taxable income for obvious reasons. Okay, so you basically have three types of accounts. I mentioned earlier your traditional IRAs, your traditional 401ks. Those are what I call tax me later accounts. You're getting a tax break today, it grows tax free, but every dollar you take out later is going to be taxed as ordinary income. Then you have the tax me now, but not later account. And those are your Roth 401ks and your Roth IRAs. And then you have the tax me as I go accounts, and those are like regular accounts at the bank where the interest that you're getting paid on your savings account, you're paying tax on that every year. And it can have a big impact on your retirement. So you want to be thinking about what the optimum strategy is. And it gets complicated enough quickly enough that I really do think you should work with a fee-only financial advisor to help you come up with a strategy. How much money should you have in each bucket? And basically think of it as you're on two paths. And again, a fee-only financial advisor can help you with this. I should mention, this is not financial advice. My goal here is to give you some information where you do your own research, and hopefully you reach out to somebody, a professional, to help you with this. I mentioned fee-only because they're a fiduciary. Fee-only advisors are fiduciaries to their clients 100% of the time. I think that's really important. You can just Google the term fee-only financial advisor and find somebody near you. But most people are going to be on one of two paths. Either those required minimum distributions that I mentioned earlier are going to trigger enough taxable income that you're going to look at that and say, gee, this is really painful. Or you're on the other path, and I'm going to talk about both of these paths, but you're on one or the other, where the RMDs are going to be painful and you want to make some changes, or where the required minimum distributions are not too painful and it keeps you in a lower tax bracket. Okay, so let's first say that you do not have a required minimum distribution problem. High level, what you want to be doing there is You want to look at your regular IRA. You want to be spending some of that money down and take advantage. So that's going to be taxed as ordinary income. But there's low tax brackets in the U.S. tax code. So you want to take advantage of those low tax brackets and get some of that money out of your regular IRA and your regular 401k. Even though it's taxed as ordinary income, the rate is low. I should say I'm not an accountant. Again, this is financial education. Work with an accountant, work with a fee-only person. This is just educational. Also, I do have a request. Hopefully you're finding this video helpful, informative, and somewhat entertaining as well. And if you do me a favor, as the kids say, thumbs for likes, subs for love, and leave a comment for us all. So again, that first path is where your RMDs aren't too onerous. It's going to put you in lower tax brackets, so you don't have a big problem. Where you end up with a big problem is if your required minimum distributions are going to put you in a fairly high tax bracket, and you're going to be paying top dollar on those required minimum distributions. And that's where strategy can really pay big dividends for you. Again, what you want to do there is you want to the extent you can, you want to be spending down that IRA that's going to be triggering the RMD. So in the early years, you want to take advantage of those lower tax rates with your IRA. Definitely take advantage of the lower tax rates there. You want to live off of your taxable account above and beyond that, so that you're not triggering, you're not putting yourself in the higher tax bracket. And then you want to think about, again, you want to work with a professional, but you want to think about, does it make sense for me to start converting some of this IRA? It's not all or nothing. You can start converting a regular IRA to a Roth over time, and you can be sensitive to the tax bracket, so you can get the 3 buckets set up the way that you want. Like I said, there's a lot of factors that go into it. I think it makes a lot of sense to work with a professional on this. Now, I mentioned earlier that the Roth IRA is a pretty powerful tool. There's kind of a 4th bucket. It's hard to get a whole lot of money into the 4th bucket, but if you're in your 30s, 40s, or even 50s, you have time. And that 4th bucket is a health savings account. And the nice thing about a health savings account, a couple things. One is there's no income limit. A lot of these tools have income limits. If you make above a certain amount, you can't participate. But with a health savings account, while there's no income limit, you do need to have a high deductible healthcare plan. I've got a video on HSAs up here, but the thing that's important about HSAs is you do get a tax break when you put money in. It does grow tax-free, and then if you spend it on qualified medical expenses, you take the money out tax-free. So it's kind of the holy of the holy grails, because it's triple taxed advantage, if you will. So I talked today about the 3 buckets. I do want you to know that there's a 4th bucket. Maybe it's more of a thimble or a pail than a bucket. But there is that 4th bucket I want you to know about. If you enjoyed today's video, I know you're going to enjoy this video up here, where I talk about the average income in retirement for Americans. In this video down here, that talks about 5 reasons to retire as soon as you can. Thanks for watching. Bye-bye.